Hey folks, welcome to Business Redefined. As always, this is your weekly most comprehensive look at the world of business, finance and economics. We want to talk about sustainability in investments and the role that insurance is playing in this space. We are privileged to have Egri Mulumbi, MD, KCB Bancassurance. Karibu sana.
Asante, Julian. Yeah.
Thank you for creating time to speak to us.
All right. It's always a pleasure to have a conversation with you.
Asante sana. Egri, let's dive straight into it. There is so much talk across Kenya and globally around sustainability. And we want to explore what insurance means for this. Let's dial back. 3 years ago, we had the Nairobi Declaration for Sustainable Insurance. What was it about? What is the progress 3 years down the line?
All right. The Nairobi Declaration referred to was actually an outcome, part of the resolutions of the African insurance organizations when they met in Nairobi at the Age Convention at the College of Insurance, and 4 pertinent issues came up. The concern was that Africa is disproportionately exposed to climate-related risks, and this then impacts our agriculture and livestock, which is in terms of the Sustainable Development Goals, that deals with poverty and also deals with food security. So there's a big concern there. The next concern was how can insurers come into play and make sure that they support in de-risking the food production industries that I've mentioned. The third aspect was the regulator's role in ensuring that the regulatory angle of running insurance companies also focused insurance businesses into supporting sustainability in that space. And lastly was just to see how insurance companies would embed the SDG reporting into their financial reporting and be accountable to all stakeholders and demonstrate that they're actually participating in this space. So coming down a few years down the line, at that particular conference, only one insurance company spoke about an SDG reporting next to their financials. Today I see there are 4 or 5 that are giving perspective on what they are doing on the sustainability goals, which is an improvement. On the regulatory perspective, regulator is supporting initiatives. One is the microinsurance space, the agriculture insurance space, and then creating awareness around how insurance can support sustainability in various sectors of the economy. So IRA drives awareness, but of concern to me is the fact that that reporting, over 50 insurance companies in the market, I'm mentioning 4 to 5 adapting. That's a concern. The second thing is that whilst the regulators created framework to support one microinsurance, support agriculture insurance, but we still don't see a lot of insurance companies coming up to take that opportunity up. We don't see insurance companies using the Bima Lab at the IRA Center to drive new solutions, new propositions that speak to the concerns around the environment, around the SDGs, around the food security that we need to drive.
Egri, you've spoken about what sounds like slow uptake by players in the insurance sector. And to be fair to them, environmental and climate-related risks oftentimes have outsized impact. And the question always being asked is, how do you exactly price in? How do you underwrite an event whose outcomes are almost uncertain, whether it's drought or floods? Don't you think the insurance companies have a point?
Yes, they do. And insurance pricing tends to derive from data, which is a historical perspective. What has happened before? What were the numbers? And how can we extrapolate based on the data that we have available? But there's also a mechanism that we must start embracing. And this is a challenge to actuarial scientists, a challenge to insurance companies. If you talk about the agri space, let's look at technology. Satellite technology should give us an estimation of rainfall in a certain area at any one time. Yeah? And from historical perspective as well, I take the area of Kitale, for example, we know the average yield that you should expect from an acre for a maize farmer in that region. This may go up or down, but the average is almost constant. So if you aggregate and you bring in enough farmers and you know the average yield, then your estimation of output based on the average should give you a top line figure that you should insure, the farmer's expected yield based on that average. Then the variable becomes the rainfall and the distribution of it and how it impacts the yield. So on average, you can then estimate that because we received this amount of rainfall in this region, the yield should be around 60–70%. Then you pay your claims based on the difference from the expected yield and the actual yield based on the actual realized rainfall amount. So that's one side of the data that we are not looking at. We prefer to look at what people have brought in terms of claims, how many farmers are involved. The challenge with that approach then is that we don't have data. So that's the first challenge. Second challenge is the process of collecting that data. And the third thing is that you then are not able to bring enough people into the insurance pool because of uncertainty in determination of their benefits, uncertainty in the pricing model. So if we do aggregation basis like we are doing and just ensure that the farming practices are standardized. And how do we standardize? By bringing in the other players in that, the value chain. Look at Syngenta, look at 1 Acre Fund. When they aggregate and they help farmers, then you have standard practice. Yeah? The input into that farming process per acre is all known, and they support farmers with the extension services so that the process should produce the standard yield that we spoke about. So all farmers coming under an aggregator should ideally target to achieve the average yield, and you should insure them on that basis. So we need to drive aggregation through such organizations who also work with the funders like banks to afford the inputs. And failing to do this means that the risk component makes this cohort of farmers, producers, unattractive to lenders. So we need to de-risk in that space through the aggregation process, control of the yield, and then just dealing with the variable that we need to insure. Take the other example on the livestock side. Yeah, I know that we have free range. You know, we allow our animals to roam and nomadic tendencies from one pasture place to another. There's need for improvement on how we do our livestock keeping. But once we do that and we get into paddocking, yeah, into ranges, then the average pasture per animal should be known. And the production of pasture, if it is totally, completely rain-fed, then you know the average consumption per animal. And diminution in that pasture availability should impact the output in the same way, so that we price at that level. We know the level of benefit, and we know that it goes down based on the rainfall. So that's the one side of it. On the flooding risks will then cause, you know, over supply of rainfall will affect the produce in a certain way. Then the yield should be determined based on the impact of flood. But the shortfall is easier to deal with. Yeah, flooding probably wipes out. So I would like to see a situation where we are balancing between the aggregated basis and expected yield, or pricing per household, which is a more complicated approach to it.
Okay. Egri, the insurance industry in Kenya and across the globe is currently navigating the transition from IFRS4 to IFRS17. And I'm very curious as to what this means for the sustainability conversation in the insurance sector, but more importantly, just for the sake of the audience, begin for us with the basics. Why this transition? What are these two standards, and why is it necessary?
So IFRS4 was actually transitional in nature. And why do I say transitional? Because it allowed non-standardized practices, but it enabled a basic reporting structure where whatever insurance companies were doing was then allowed to push through. Three major things that it encouraged. One, there was no comparability, basis for comparability. Looking at my insurance liabilities as a general insurer or a life insurer, I would use my own methods, engage my own actuaries, and they would determine my actuarial liabilities for the future from the insurances I've taken today. And a different actuary would develop their models based on their own market. A lot of the times, the actuarial firms that we used were external. So you have a South African firm coming to do the actuarial valuation for your company. They use the South African model. Another one will use Malaysian. Another one will use the UK. And for an investor, then you don't have a proper basis of comparability. The performance is reported on individual basis. Comparison is difficult. And that meant that our focus and even the regulators' focus was more on solvency rather than sustainability. So the IFRS 17 has focused on sustainability, where we have come up with a basis. And the focus is more on the basis of insurance liability quantification based on the investments that you have, the funds that you have built, and the premiums that you've taken today, yeah, and then the impact, the difference between the funding, let me call it a funding gap between your liabilities and your investments, and goes on to even focus on the computation of profitability. Yeah, because you've taken into account the liabilities that you have today and what you're likely to accrue in future and what's their impact, bringing them to present value. There's that concept of present value of future liabilities, which is very prominent in that space. So this enhances comparability. The next thing is done is to bring in the governance perspective, where the board is supposed to put in place governance practices which speak to the future and sustainability of that business into the future as well. So it's a more comfortable space for investors in insurance business to start thinking that their businesses are sustainable. The ways of computing their returns today is not just for here and now, but is for the future. So the future outlook of the company becomes clearer, can attract other investments, can help project the growth trajectory. And for the insurance contract liability owners, who are the insured,
Yes.
yeah, that transparency, you're starting to see and evaluate an insurance company as you place your risks on the basis of are they sustainable. Some insurance contracts are for the long term. Yeah, the life insurance, the pension funds, and so forth. You can't do them, for example, purely on the current returns, but you need to look at how safe your money is into the future. So I find that that support from the sustainability perspective for IFRS 17 is a lot clearer, and it should help the insurance industry.
There are those who've argued that because of precisely what you've talked about in terms of the long term and how you recognize your anticipated performance, whether it is profit or loss, it should help in accelerating consolidation in Kenya's insurance industry, which, I don't know whether you think about this, but is widely perceived to be vastly fragmented. Would you expect that?
Vastly fragmented indeed. And consolidation or no consolidation, I think the big thing is we need to go out as insurers and demonstrate that we have solid insurance companies. Yeah, there are people who have invested in the businesses that they run. The requirement, when you look at the long-term sustainability transition to IFRS 17, then they may need to inject capital. And IFRS 17 also deals with that capital allocation, the mapping of your risks and allocation of your capital to those specific risks. Now, a few investors who are looking for returns and who in the past were looking for short-term current returns will find that now there's a call to inject more capital into their business. Then they have option. Bring in funding propositions, bring in other investors to support, and those may be existing companies or other companies, like the venture capitalists, yeah, the specialist investment funds who will be looking for returns. That concept may help us to improve the governance structures, yeah, around our insurance companies and focus in the right direction, because they will be driving a lot of the sustainability agenda and a lot of return on investment for them as shareholders. But is there a problem with having too many insurance companies? No. From a penetration perspective, 2.5% or thereabout penetration. So there's a huge opportunity. And that huge opportunity is why we've seen an influx of top international insurance companies coming to get stake. You know, reinsurers like Swiss Re, these are some of the largest reinsurers in the world, see an opportunity in this market and they come to support existing insurance companies to align to best practice so that we can harvest that value that is untapped in our market today. Two other players that you may look at, the banking sector with a stronger capital base and better cost management approach is starting to look at investing in insurance companies. You've seen some acquisitions and consolidations where in banks, the banking sector players are coming into the insurance company space. Those acquisitions will continue as well to strengthen the capital base and to make insurance more appealing to the customer base.
You're talking about the low penetration of insurance in this country, 2.5%. What exactly is the challenge? We've been in the 2.5%, 3% horizon for such a long time. And you'll remember when bancassurance was rolled out in this market, we were told this is the game changer. Here we are, a number of years down the line, and it looks like we are not moving the needle.
Okay, let me start with bancassurance. You know how passionate I am about that space. So bancassurance has done a very good thing for the insurance industry today. First, premium collection. And as I speak about premium collection, I've seen circular from the regulator. This is the licensing application for 2025 licensing period. Bancassurance entities must submit by 30th September. Two major requirements that have changed. Submission of clearance of premiums for the period 2022 and also for 2023. That in itself means that there's a collection issue that bancassurance has addressed, bridging the funding gap for customers to access premiums and to pay. And the regulator is looking at that. They're trying to make sure that we do it. Yeah. The second thing is the ease of access and enlarging the distribution platform. In KCB, over 200 branches, I think 206 branches, all those are touch points for insurance. Yeah? The digital investments KCB has done supports my business, the bancassurance line of business. So access to readily accepted insurance, internet and digital platforms is another thing. And I think the regulators not consolidated data for insurance, bancassurance entities. They promised to do that from this year. It would be nice to see, in our estimation, 25 to 28% of premiums in this market is now written through bancassurance intermediaries. Yeah? And then the governance is more solid. But back to the penetration question. When we compute the GDP, we bring in assets created in the country. Some of them are in the infrastructure space. Some of those things will hit our GDP, but the funding structure is such that the money, and let's speak about the highway, what do you call it, expressway, for example. I think the funding model brought in things without creating insurable assets in this country. So you end up with a road but and impact on the GDP of the country, but you have not employed people, you've not bought a lot of materials in this country, which are the insurable assets. So that measure in itself, sometimes we miss. There's a little mismatch in the measure. Yeah. So I always support the prospect that we should look at the premium income growth and does it reflect the growth of the businesses that we support. We should also isolate and look at the growth of the insurable assets and lives. Yeah? And the third thing is to look at two sets, the number of lives that are actually insured for the life insurances, for the medical insurance policies. Then you find a way to measure the impact better than when you're just looking at a percentage of the GDP, because the growth rate, and I remember the minister, CS for Finance today saying zero-based budget. Yes. Yeah, because the budget itself is a trigger of where our GDP is going to be. And if we actually look at the insurable assets created in the economy, we will have a clearer measure of the premium growth.
I see.
Yeah.
Another thing which has long been touted as a game changer in this market has been microinsurance. Egri, what's your assessment of the penetration and the impact of microinsurance, and do you think it is pushing insurance, which is largely a perceived elitist product, further downstream to the bottom of the pyramid the way it was designed?
Desired achievement is progressive, but let me highlight maybe a few risks that I think the micro segment faces. Yeah. The micro enterprises, micro and small enterprises, most of the times are one risk away, one disaster away from total collapse. And these disasters may come in what way? A major illness in the family, death, the fires that we've seen occasionally, a shop burns down, burglary and robbery, the floods if they're in the agribusiness. So that vulnerability means that insurance must come into play its due and rightful role. Yet, if you look at a shopkeeper, the margins are very narrow. So given the narrow margins, additional expense to take insurance, you start balancing and you pray to God that nothing happens. So there's a lot of insurance that we've placed in our faith in God, but which we can deal with through the insurance companies. Then we have had an issue around the distribution model, because the segment that we are talking about needs support in terms of financial literacy. Yeah? They need the insurance. They are vulnerable. They don't know that insurance provides the right protection. So what's the distribution model? We try to solve for it by thinking that we can do cheap products. You pay in a day, daily premiums, and you pay on phone. Yes, that enables, but why do I pay for something I don't know? So the distribution model must speak to, I think that segment needs high advice, and I would just ask our regulator to focus on enabling more aggregators and welfare units or business aggregation units to drive the insurance conversation in that space. Because the products are in place, and in insurance our innovation tends to be around, are we creating products? Yes, they have been created for that segment. I think the next level of innovation for the insurance industry is, are we redistributing the products in the right way so that we're able to reach and communicate effectively to the people we want to talk to about those products, then make them understand.
Egri, my final question is this. When you talk about sustainable investments, oftentimes sustainability and return on investment don't go hand in hand.
Sure.
In the insurance space, how are you navigating that reality?
Sustainability talks about the long term, and there are some investment decisions then that must be taken. They may not give immediate return, but they will give long term returns to shareholders and to all stakeholders actually. So how does this go with insurance companies? They are deposit mobilizers. The first thing that we need to do in insurance is to make sure that the investments, the investment of funds that we are doing from the insurance companies also speak to the sustainability agenda. We are investing in areas that will enable us to have customers in future, yeah? And they are profitable anyway. If you're investing in schools, I spoke about education policies. Shouldn't insurance companies then invest in schools? There are lots of private schools issues that come up. We want to protect, we want to insure the schools, but shouldn't we find a mechanism to support people who want to invest in that? Hospitals, for affordable health, shouldn't we invest in that? Channel investments into that. Heavy infrastructural involvement, but over time, and for insurance companies, you will be able to control the entire ecosystem for the product that you are offering. You're generating a market, you're supporting the infrastructure in that space, yeah? And you're also looking into the future by protecting the investments that have already been made there. So investment fund managers in insurance companies ideally should be given a 5-year minimum time horizon to deliver returns, especially for the long-term funds, rather than the here and now. Yeah, and we compete on that basis of here and now.
Agree. Thank you for your time.
Asante sana.
We've been having a conversation with Egri Mulumbi, MD, KCB Bancassurance, focusing on the subjects of sustainability insurance and finally drilling into the question of bancassurance and whether it has lived up to the promise. We shall continue keeping tabs on these issues to bring in the latest as it emerges. Stay tuned.